Welcome to Talk Tickers. Today, we're diving into Organigram, a company that just dropped an earnings report with a massive miss. And then its stock just took off. I mean, how does that even happen? Let's break it all down.
Okay, so right off the bat, this report looks like a total puzzle. On one hand, you've got GAAP earnings per share coming in at a 20-cent loss. Analysts were expecting a 1-cent loss, so that's a huge miss. But then, on the other hand, their revenue absolutely crushed it, hitting almost $57 million. So you see the problem, right? A big loss, but explosive sales. The real question for investors was, which of these numbers tells the true story?
Well, the market's answer was loud and clear. The stock rallied nearly 8% on the day. It's like investors took one look at that headline loss, tossed it in the trash, and decided to focus on the company's momentum and its vision for the future. So what's with the disconnect? That's exactly what we're going to unpack. The whole answer really is in looking right past what we call accounting noise. You see, that big net loss, it was mostly driven by non-cash stuff, like weird changes in the value of financial instruments. Most savvy investors see these as just paper losses. They don't really reflect the actual health of the day-to-day business. They wanted to know how the core operations were really doing. And you've got to hand it to Organigram's management team. They did an expert job of controlling the narrative here. On the earnings call, they just kept bringing the focus back to what really matters. Selling a better mix of products, getting more efficient, and, this is a big one, nailing the integration of their recent acquisitions. So let's start with that top line. The company posted a record quarterly net revenue of 80.1 million Canadian dollars. This number is the heart of their growth story. I mean, we're talking about a 79% increase from the same time last year. This wasn't just a tiny beat. It was a powerful signal that this company knows how to scale. But here's the thing. It wasn't just growth for growth's sake. The numbers underneath were also incredibly strong. Their adjusted gross margin went up by 400 basis points. That's a full 4 percentage points to 38%. And adjusted EBITDA, it jumped 69% to almost 10 million Canadian. In fact, get this, they generated more adjusted EBITDA in this one quarter than they did in all of fiscal 2024. Now that is what operating leverage looks like in action. A huge piece of this execution story comes from the Motif acquisition. Management confirms they've already squeezed out over $7 million in cost savings. That puts them right on track to hit their $15 million goal. This is a tangible, real-world sign that they can buy another company and actually create value from it, which, trust me, is something a lot of companies in this space have really struggled with. All right, so with that fantastic operational performance setting the stage, the conversation naturally turns to, okay, great, what's next? And management didn't just deliver a great quarter. They also laid out a super clear and really bullish path forward for everyone. So the headline guidance for fiscal 2026 is for net revenue to blow past 300 million Canadian dollars. That suggests another year of really strong double-digit growth. And crucially, they also said they expect margins to keep expanding, and here's the holy grail for a company like this, they're targeting positive free cash flow for the whole year. This is exactly the kind of forward-looking promise that gets investors fired up. Now, one of the biggest potential game changers on the horizon is something called EU-GMP certification. For anyone who's not familiar, think of it as a golden ticket. It's a super strict quality standard you have to meet to sell medical products in Europe. Getting this certification is the key that unlocks access to these high-margin European markets, especially Germany, which has just seen crazy growth right now. This is the absolute centerpiece of their whole international strategy. And this slide basically lays out the roadmap for the next 12 months. So we've got a leadership change coming up with new CEO James Yamanaka taking over in mid-January. He brings a ton of global experience. Then all eyes will be on that critical EU-GMP decision. And all throughout the year, the company's going to be laser-focused on hitting that positive free cash flow target. These are 3 clear, tangible milestones for all of us to watch. And here's some really important context. While Organigram has done pretty well, it's actually lagged way behind the rally we've seen in the broader U.S. cannabis sector, which you can see here with the MSOS ETF. Now, what does that suggest? It suggests that if the company keeps executing on its plan and hits these goals, there could be a lot of room for this stock to run as its valuation plays catch up with its peers. So, how do we wrap all of this up? We've seen the operational strength, we get the catalysts that are on the horizon. Now let's turn all of that into a solid investment thesis. So, what is the trade? Here is our actionable take on Organigram, and it's what we're calling the next call. we are assigning an outperform rating to Organigram. Our whole thesis is that this stock is going to re-rate higher as the story about the company fundamentally changes. See, right now, it's mainly seen as just another player fighting for market share in Canada, but the real value is going to be unlocked as it becomes a high-margin international growth company, and that whole transformation really hinges on getting that EU-GMP certification. Once that approval comes through, we expect the focus to shift hard to places like Germany and Australia, where the margins are way more attractive. Now, the main risk to keep an eye on is regulatory. Their new beverage line in the US uses hemp-derived THC, which kind of exists in a legal gray area right now. It's not a big part of their revenue today, but any kind of regulatory crackdown could definitely threaten that potential avenue for growth.
This is not financial advice.